If you watch the news, you would already know that inflation is perhaps the hottest headline across the world for some months now. In May 2021, the US inflation rate reached a record 9.1%, and in August, the UK inflation rate reached a 40-year high of 10.1%, which was a reflection of growing inflation across Europe. Inflation rates are even worse in South America, Africa, and Asia. To check inflation, central banks around the world use various methods, but the most popular strategy is to increase interest rates. It is likely you have been seeing news about the central bank increasing interest rates in order to bring inflation under control recently. How does raising interest rates bring inflation down? This video would be answering that question. Relationship between interest rates and inflation. The first question we need to answer is, what is the relationship between inflation and interest rates? The relationship is simply money. Both interest rates and inflation are controlled and affected by money supply. If there is a lot of money in circulation, then people will have a lot more money to spend. Everyone wants to buy the same things, so we are willing to pay more just to get those things. Because supply is limited, prices naturally go up. Also, because there is so much money in circulation, banks lower the interest rates of their loans. If their interest rate is too high, no one will want to take the loan because they already have a lot of money to spend. And if interest rates for loans are very low, people take more loans, hence the money in circulation increases. Another reason why inflation happens is when unemployment is very low. Now, this may shock you. Governments always intentionally increase unemployment just to control inflation, and they do this by increasing interest rates. How and why this is done would be revealed later in the video, so watch till the end. There are several options to the government to control inflation, but increasing interest rates has proven to be one of the most effective ways. Historically, one of the most successful cases of inflation reduction was that of Paul Volcker, former head of the Federal Reserve. In 1979, when Volcker became the head of the Federal Reserve, inflation was at the highest rate it had ever been since World War II at 13.35%. The country was in a severe recession, and it looked certain it was going to slip into a depression. If you want to know how different a recession is to a depression, then you should subscribe to the channel and check out our video on the difference between a recession and depression. In October 1979, Volcker had set the interest rate at an extremely high 13.7%. After 6 months, the Fed chairman would raise interest again, this time to 17.6%. Within the next year, interest rate was over 19%. These are extremely high interest rates, and they were increased very sharply. Economists call this aggressive tightening. Did it work? We know it worked because by 1982, inflation was down to 3.8%. It even went as low as 1.1% in 1986, before the government started reducing rates again. The example of Paul Volcker has been a model many central banks have continued using, and what Jerome Powell, the current head of the Federal Reserve, is also using now. Interest rates affect credit cards. Increasing interest rates targets inflation from several fronts. High interest rates causes credit to be unattractive, which would make people take out less credit, hence spend less money. When the Fed increases interest, it directly affects every interest rate from every financial institutions and credit providers, even your credit card annual percentage rate APR. Getting a notification that your credit card's APR has gone up and likely to increase further would make you think twice before you use credit to make any payments. This would cut down on the National Personal Consumption Expenditures, PCE. The New York Federal Reserve Bank estimates that an average American has about $3,500 in credit card debts, and national credit card debt balance is about $887 billion. The Fed can cut a lot of PCE by hiking rates, thereby strangling demand. The lower the demand is, the lower inflation goes. Reduce business spending. The Fed also targets business spending. According to the Federal Reserve Financial Stability Report for household and small businesses debts, in 2021, households and SMEs owned a total debt of $17.7 trillion. This is more than half of the $30 trillion of the U.S. national debt. Again, increasing interest rates would see this SME debt slow down. When credit is easily accessible, businesses take more risks. They are growing and expanding, therefore increasing their demand for energy and raw materials. The businesses are also recruiting massively, thereby keeping unemployment low. If unemployment is too low compared to GDP growth, there would be a problem of inflation, when a lot of people would have money to spend, but the national production is not growing fast enough to support the growth in employment. This is why the government intentionally causes unemployment to rise to manageable levels by raising rates. Forces purchase of treasury bonds. When the government buys treasuries, more money goes into circulation and the Fed's deficit increases. This huge deficit can cause a currency devaluation, hence inflation. One solution to this is to cause a constrictive economy where investing in the equities market becomes too risky and treasuries become very unattractive for investors. The Feds can achieve this by increasing interest rates. If you have been paying attention to the assets market, you would have noticed that anytime the Fed announces a rate hike, the assets market always crashes. Because treasury bonds are safe, investors move their money from the volatile stocks market, commodities market, and even from the cryptocurrency market and put their funds in treasury bills. This purchase puts money back into the Federal Reserve and reduces their balance sheet. Naturally, treasurers are not desirable for investors that want good returns, but they are more reliable than equities and cryptocurrencies. Discount rates for banks. The Fed also targets commercial banks through rate hikes. Commercial banks control the bulk of all money flows. Banks have a system through which they borrow from the central bank called the discount window. These loans are short-term and meant to sustain the bank's liquidity. The Federal Reserve charges a discount rate for these loans to the commercial banks. By increasing interest fees, banks are discouraged from using this service to raise liquidity, thereby reducing the bank's money supply. This has a negative effect on M2, which in turn has effect on inflation. Cheaper imports. High cost of commodity importation is another major cause of commodities price hike. If imports can be cheaper, essential commodities such as food commodities and oil becomes cheaper to import. Food commodities and oil account for the bulk of costs that drive inflation. That means having cheaper imports would cut inflation down significantly. By increasing interest rates, the currency strengthens against other currencies, which drives the cost of importation down. Other options for controlling inflation. Increasing interest rates is not the only way the government controls inflation. The government can introduce other policies, such as price controls, just like the one imposed by President Nixon in 1971, which was an intrusive way of controlling inflation. The government does this by directly setting prices for businesses it believes are overpricing. In a capitalist economy, businesses can set their own price to ensure profitability. But unfortunately, some businesses conspire to set their prices really high. U.S. pharmaceutical companies have been recently accused by former U.S. Senator Bernie Sanders of doing this. To curtail artificially induced inflation, the government can wade in to set price limits for an industry. The problem with this strategy is it is targeted and could cause a lot of pushback from the affected industries. Governments have also used wage controls in the past. Inflation can be caused by rapidly growing wages. When people start earning a lot of money, manufacturers and businesses would want some of that money to flow to them too. This results in price hikes that are based on sentiments and not economic conditions. The problem with trying to limit what people can earn in the political backlash that is likely to follow. Any government that introduces wage limits is bound to be unpopular with the people and unlikely to win elections. So this is an undesirable way of controlling inflation. Over time, the government has found that increasing interest rates was one of the most effective ways of controlling inflation without having to confront any sector of the economy directly. This strategy has its critics too because it leads to unemployment and also shrinks investments across all markets. Do you think increasing unemployment is worth the reward of bringing inflation down? Leave your thoughts in the comments below. Don't forget to like and subscribe to the channel. It really helps our content reach more people. Thanks for watching.